Hello, my name is Matthew Rivera, and for this creative posting assignment, at least for this segment, I will be introducing my client, Chad Spinazzi, and talking to his accountant of two proposed transactions that Chad would like to make, which is giving his remainder interest of the home of his personal residence to a charity, then also using the proceeds from that to buy eyelid insurance for his two boys. And I'll be giving some calculations and benefits of why he would like this to have done. Okay, some client information. His name is Chad Spinazzi. He's 33 years old, and he's currently single. He has twin boys, which are 5 years old. Their names are Cameron and Jordan. As far as occupation goes, he's a retired professional tennis player. He started his career in 1998 and just recently retired. His career earnings, he accumulated $9,902,000. And for 2011, his earnings are $950,450. A little more information on my client. His resident value is $2,550,000. Some of his goals that he would like to accomplish is he would like life insurance for his twin boys, just so they're taken care of after he passes away, and also because he's a single parent, he wants to make sure that they're taken care of. He would also like to have them go to a private school all through college, if possible. And then he would like to donate his house to a junior tennis academy, which is a public charity. And then in the near future, start a tennis academy. We had a lot of debate of which public charity he would like to the remainder of interest of his house to go to. After doing a lot of research and meeting with Chad, it sounded like he had a great passion for tennis. It seems like he had a great story of when he was a youth, his parents did not have the means to send him to elite tournaments and camps, and he showed a lot of promise in his young junior years that the USTA and NJTL, which are junior systems for the tennis world, really took him in and helped him out with finance and gave him opportunities that he would not be able to attain on his own or with his parents' help. So he thought it was very important to give back to the sport that's given him so much. So that's why he chose the junior tennis, which is mainly for juniors, and he wants to maybe create the next superstar, or maybe the next him, and have a great career. So that's something he was very passionate about, so that's why we chose the junior tennis public charity. The proposed transactions that Chad would like to do: he would like to give a remainder interest in a personal residence to charity, which is the junior tennis organizations that we just talked about. And then he would also like to use the proceeds to purchase life insurance in the islet for his twin boys. Okay, as far as calculations go, first we would have to find the depreciation reduction factor. And let me go over here really quick. And this is the formula that we're going to be using, and then I'll show you where I got all the numbers from. And pretty much the formula is you have to find the R factor of the age of right now, and then subtract that from the R factor of the age of the useful life. And then you would divide that by the D factor of the age now and multiply it by the useful life of the house. And as far as the useful life of the house goes, we're going to use 45 years. As far as the IRS is concerned, this is the example they use, so we're going to use 45 years for this information. Okay, and going back to this slide, we went to, after going to the IRS website, we went to Table C, and then we went to September 11th. We went to September, which is the month that we're currently in 2011. And what we did is we went to the interest, and right now the interest rate is 2.2%, which is a great percentage of right now, because you're going to very rarely find it as low as it is right now. So this is one reason we thought we should move on it right away. So yeah, pretty much all you have to do is go to the Table C and then go down to the current month, September, and find that interest rate. So once we found the interest rate, we went down to this table, and I did a little cut and paste. I did a little cut and paste here just so it could be easier on the eye, so we wouldn't have to be scrolling through a lot of information. Since Chad is 33 years old, you would go down to the R factor column, and you would get that number that's highlighted, and then you would subtract that from the useful life. And since we determined that to be 45 years, we added 33, which is age, plus the 45 years, which gives you 78, and that's how you found the R factor for that number. So you would subtract those two numbers, and then you would divide that, going back down to the formula, you would go back to the 33 years of age and find the D factor of right now, and you would get that number, which is also highlighted, and then you would multiply that by 45 years that we already determined. And once you do all that calculations, I showed you the simplified version, and once you work out that problem, you would get 0.3511. And that we're not done exactly yet, because that interest rate, if we were to just multiply that from the value of the house, that would give you an incorrect number, because as we know with residents or houses, they depreciate. So if you would give that number, it'd be the value wouldn't be correct. So what I had to do is I had to go to another I had to go on the IRS website again, and then this time I went to Table S, and once again we went to September 2011, and we found the interest rate at 2%, which is the given for this month. And you would have to find the table for his age, 33 years, and then you would get the remainder, which is highlighted there. Okay, and then going to the calculations, you can see going back to the first two slides, the residence value is $2,550,000 of his home. And like I said, since houses do depreciate, you can't just use the numbers that we found, the remainder for the reduction factor, or the one that I previously showed. You can't use those and just multiply it, because that'd give you an incorrect number. Because, like I said, the houses do depreciate, so you need to figure out which part is salvageable and then which part is part of the land. So let's assume the house, some disaster happens to the house and it gets knocked down. Whatever's salvageable, we have to get a percentage of that, and then obviously the land that the house is on is worth something as well. So what I did is I took 20% of the land, which you would get 20% of the value of the house, and that number is $510,000, and you would multiply that by the number that I just found for the remainder interest. Okay, and that calculations, once you multiply those two numbers together, you would get $215,000, $286.30. Okay, and then for the salvage value, I took 10% of the value of the home, which gave $255,000. And once again, you would multiply that by the remainder, and that value gave you $107,643.15. And then pretty much all you have to do is find the remainder of the value of the house, which would give you $1,785,000. And that is where we get the you would multiply that by 0.0710. And the way we got that number is we would subtract the first remainder interest of the 0.42213, and then you would subtract that by the number we calculated up here for the depreciation reduction factor of 0.3511. So once you subtract those two numbers, that's how you got the 0.0710. You would multiply that by that amount, and you would get $126,000 and $126,735. Once you add all those numbers together, you get a grand total of $449,000, $664.45 of a deduction. Okay, and the great thing about that deduction is you would be able to reduce that from the taxable income, and we'll go into that shortly. Okay, and as far as the second proposal that Chad would like to make, he would like to purchase the ILIT insurance just in case he passes away, or when he passes away, he wants to make sure that his two boys are covered and have something to fall back on. So what I did is I took the deduction amount of what we just calculated, and that would actually buy $1,348,993.35 worth of paid up ILIT life insurance. And the way I got that is I took the deduction amount from the previous slide and I multiplied that by 3, which is 1/3 of the death benefit, and that's how we got that number. And pretty much, like I said, this is going to be a state tax-free life insurance for his child's inheritance. So once he passes away, they will get this amount tax-free, and they'll have something to fall back on, and they'll be taken care of. Okay. Okay, and now just before I go into some benefits of this, I would also like to show a comparison of what it does to its taxable income and the amount owed on taxes, which is another benefit and a reason why we like to act on this right away. Just on this slide, we could show the comparison without, if he were to would not have a remainder interest. So going back to the first slide, we found out that his income for this year is $950,450, and since he's in the top tax rate, he's going to be taxed at 35%, which gives you $332,657.50 of taxes owed. Now, this is the amount he would pay if he did not do the remainder interest in his personal residence. Okay. Now, if we go through with this remainder interest, he would get a new amount. Once again, his taxable income stays the same. This time we would deduct the deduction that we calculated previously of $449,664.45, which gives you a new taxable income of $500,785.50. And once again, since he's in the top tax bracket, he would get taxed at 35%, which would give you the taxes owed of $175,274.94. You can see the big difference on that. Actually, the deduction that we calculated of the $449,664.45 is actually worth to Chad $157,302.56. This amount is very important because, like I said, Chad would like his two boys to go through a private school, great education, and hopefully, if they decide to go to college, hopefully a private school, if not, whatever institute they would like to go to. He would like to start an education fund for his boys. He would not use his whole amount, but he would use a portion of this that he would not have had if he did not do the remainder interest. So he would like to do this remainder of interest not only to get the remainder interest deduction and not only to pay for the purchase of his life eyelid insurance for his children, but also so he could start a college fund for his two boys, which is a great great idea of since he's being a single parent as of the moment. He wants to make sure his boys get a great education and have that are protected once he passes away. And just some additional benefits of this two proposals. He would get immediate income tax deduction. We already went over that. He would have the complete right of ownership, which is retained for life or any period the donor determines. So that's a great benefit. And just in case he decides to make any improvements to his home, he would get to deduct the remainder value of all major improvements as an additional gift. And he could also receive any income it generates. So those are all great benefits why he would like to do this transaction. So hopefully with the calculations and all the benefits that I've discussed, hopefully this sounds really good to you, and hopefully we can move forward and go to the next phase with Chad, and I'll be able to explain to him whether we could go forward with this or not.